Good afternoon, this is Charles Kelly, Money Tips. How are you doing today? I'm the author of several books, including Yes, Money Can Buy You Happiness and a newly published book, Borrow and Grow Rich. And I wanted to talk about interest rates today because I've been talking about this for several months, and finally the Bank of England this week have raised interest rates to 0.25%, and this is to cope with soaring inflation, which is now running at over 5%, 5.1%. That's double the official rate. And the inflation rate is now, or prices are rising now at the fastest rate for 10 years. And similar things are happening in America and Germany and other countries. So do watch out for that. You might think, inflation, what's 5%? But this is eating away at your savings. It's eating away at your buying power. It means that if your income is not going up by 5%, then you are falling behind year on year. Now, we're normally used to an inflation rate of 2 or 3%, so we don't really think about that very much. But that's still eating away at your money. But when it gets to 5 and 10%, at 10%, the value of your money will halve in about 7 years if it's just sitting in the bank earning not very much. So you've got to watch this, and it is important. And banks across the world, central banks don't like inflation, so they always move to step in and do something about it. And that is, in this case, the blunt instrument is raise interest rates and slow things down. Now, I thought they might not do it before Christmas because the economy needs a boost, and it's already been hit by this new variant. So that's already slowing things down. But they've gone ahead and done it. It's not a big rise, but it might dampen things down a bit. And this is the Bank of England, the Monetary Policy Committee. 8 out of 9 of the members voted to increase the rate despite the economy slowing down with this new variant, and the government have announced some measures which they haven't closed down hospitality, but they've more or less said to people, don't go out, in so many words. So a lot of people are cancelling bookings of office parties and that sort of thing. So it's really hitting the hospitality sector. I was in town this week in London, and things were very quiet. I met a few friends for a drink, and I thought, well, everywhere was going to be full. It was I can't remember what night. It was a midweek night, but I thought a lot of places would be full. But surprisingly enough, there were a lot of empty restaurants and bars there. It seemed very, very quiet to me, and even on the trains and that sort of, it did seem very, very quiet. Now, obviously, the Bank of England's action will have a knock-on effect on mortgage rates, and it will hit the cost of home buyers buying a home, obviously. But these are for people that haven't got a fixed rate. So, if you haven't got a fixed rate, maybe now's the time to start talking to your advisor, because there could be further interest rate rises in the near future, maybe this coming 2022. But obviously it's going to affect things, particularly businesses with large loans, and if they're not fixed. But even if you're on a fixed rate, these rates in this country, we tend to have fixed rates between 2 and 5 years, sometimes a bit longer. And when they come up for renewal, that's when your cost of your mortgage can go up substantially if the lower fixed rate is no longer available. I had a fixed rate come up for renewal last year at a time when rates had already been dropped to the lowest level in history, and yet the bank still charged me more for my fixed rate. So what are they going to do now when rates have just gone up? I would imagine a lot of the good deals will be withdrawn, but you can still get some good fixed rate deals because interest rates are still at a reasonably low rate. They're still at near historical low rate. So you can still get a fixed rate if you're just on a variable rate right now. So we're talking about inflation then, running at 5.1%, the highest rate for over a decade, and double the bank's rate. And the Bank of England Governor, Andrew Bailey, expects inflation to rise to 6% early next year. Now, I know, and most of us do know, the real cost of living and the real cost of just basic things is rising much higher, I think, than the official inflation rate. I don't think of 5%. I'm thinking more like 10% myself, what I see. And just, I know you can give anecdotal examples of fuel and petrol and that sort of thing, but I suppose the government measures it over hundreds of items. But for the items that we need on a day-to-day basis, there's been a sharp increase in wholesale gas prices, which again is not necessarily the fault of the government here, and that's driving inflation, fuel prices, and that's going to push up domestic energy bills this year for some people as much as 40%, and that's quite a big chunk of your household bills during the winter, and we know that inflation is rising everywhere, and these things have an effect on all businesses. If I talk to my local restaurant, he says, well, yeah, my transport costs have gone up, my raw materials, my food and my fuel and my cooking oil has all gone up in price by a lot more than 5%, sometimes in some cases 50 or 60%. So, we know that this is going to have a knock-on effect on everybody, and because they will have to pass on higher prices to their consumers. And I'm already seeing this. I'm seeing higher prices and smaller portions, smaller packages. So that's another way of increasing prices. So we know that inflation is rising around the world, and this is partly fueled by money printing on an industrial scale that we've never seen in history. More money has been printed in the last 10 years than at any time in history. So, we're just seeing inflation hit many countries, including Germany, which of course has a history of bad, a long memory of inflation and how it hit their currency in the Weimar Republic before Hitler came to power. So, they don't like inflation. They always will stamp on inflation. Now, the US official rate of inflation is 6.8%. That's the highest it's been for over a decade, but half the rate suggested by a firm called Shadow Stats. They kind of look at the government stats and come up with their own, what they call the real stats, and they claim that real costs are rising by 15%. And I think in America they don't include the cost of home ownership. So, we know that homes have gone up by an awful lot in America, some as high as 20% in some places. So they're claiming 15%. And, when it comes to the cost of buying home, as I said, rates are still at an historic low. I think it's unlikely to have a knee-jerk effect on property prices or demand unless rates go up in the future again. And the FT has recently reported that the Federal Reserve in America expects 3 interest rate rises next year. So that's not going to be much fun. And that's to combat their inflation. And yet the stock markets on that news went up. They actually went up on this announcement, even though there will be 3 interest rate rises coming in the next year. I don't quite understand that. But, I wouldn't panic yet with housing, and we just have to see how rates go. But if rates do go up to higher rates, then we could see a dampening of the housing market. That's been my experience in the past. When interest rates are high, housing can go down. But, there's a whole range of things you've got to take into account, like demand, like there's a shortage of housing in most countries with increasing population. Now, if you think to yourself, well, inflation is not going to affect me, interest rates are not going to affect me, I don't have a mortgage, I don't have loans, I don't have debts. Well, think again. Governments now owe trillions of dollars. I think the national debt in the UK is over 2 trillion. In America, I don't know what it is, 30 trillion. And then you've got the central banks as well in Europe and euros. Trillions of dollars, pounds, and euros are owed to bondholders. They will have to pay higher interest rates to service the debt that they have created by money printed and by buying all these bonds. So who's going to pay for that? Well, that's right, taxpayers. What's 0.25% of $100 trillion? It's a lot of money, right? I can't work that out in my head. Is it so many billion, 25 billion a year? Correct me if I'm wrong there. But we're all going to have to pay that in some way, and that's going to be through higher taxes, reduced services maybe. So, and I know that savers now will welcome the higher rates. I was talking to someone the other day who has a lot of money sitting on deposit. She doesn't want to invest it in the stock market. She doesn't want to do anything with it. She's retired. Her standard of living is falling because the money is losing its buying power, and she's eating into the capital because she needs to spend. So people like her will welcome higher interest rates. So just a final warning before I move on now is don't get into debt this Christmas. Just a friendly warning to avoid spending money that you don't have and getting into debt this Christmas, especially with these higher rates on credit cards, which are coming soon. Credit card rates are scandalous. What, 16%, 18, 20, 30%, when base rates are like almost 0.25% now. Yeah, big deal. But the banks have been charging, multiple times the base rates on which they can obtain money to people with credit cards and overdrafts. So just watch out for that one. One solution could be to hold a family truce and say, look, I can't do Christmas the way we used to do it. We'll have to have a truce on presents. Maybe we'll have some novelty presents for, a tenner each or 20 each or something like that. Or just opt out and say, look, I can't do it. I'm out. Don't get me anything. I won't get you anything. I think you can still have a good, fun Christmas without getting into debt and paying for it, maybe for the rest of next year. So just watch that. As usual, consult your financial advisor. Financial education is important. It's vital in any form of investing, in order to not only earn money and create money, but to keep it as well. So keep watching my free stuff. Like and subscribe these videos wherever you are watching it from, and spread the word, as they say. But I wanted to tell you one more quick thing about my new book launch, which is called Borrow and Grow Rich, and I've got a special offer for you. Now, I cover these things in a lot of financial education, which you can find in my book Borrow and Grow Rich. It's available on pre-order on Kindle right now. If you order that on Kindle, I'll give you a copy of this, a PDF copy of this, for free. If you send me the proof of that, I'll send you a free PDF of that. But I wanted to give you another special offer, which is I want to give away the first 2 chapters of the new book, Borrow and Grow Rich, for absolutely free. And you'll see a link there. You can get the link there, download chapters 1 and 2 for free, and get a taste of what I'm talking about. Because it's all very well trying to save and save and save, but you're very unlikely to get rich just by saving alone and economizing by alone. You need leverage. Most people get rich using leverage, and that's what I talk about in great detail in my book, Borrow and Grow Rich. Most of the people I know that are wealthy and super wealthy have done it using what they call OPM, other people's money, and using leverage. Leverage means, if you can't move that rock, I think it was Archimedes in ancient Greece, said that by getting a long pole, you get more leverage and you can move that heavy object. Well, that's why they use the term leverage as an analogy for borrowing money, for making it easier to get what you want and get it faster. It doesn't mean going out and getting into stupid debt to buy consumer goods. I'm talking about good debt as opposed to bad debt, which is buying presents for Christmas on credit cards that you can't afford. Good debt is buying property, buying companies, buying businesses, raising money to start a business. And that's how, if you look at the Zuckerbergs and people that started companies like Amazon and Tesla, they didn't do it just by saving money and starting it and staying in their garage for 50 years. They did it eventually with institutional money, with money to give them that lift up. Same with Google. They couldn't have done it just, they might have been 2 college dropouts or whatever, but they couldn't have got to where they were without leverage and other people's money. So do have a look at that. And I wish you all well. Stay safe out there, and keep reading my free stuff, and do have a look at that free offer of the first 2 chapters free of my book, Borrow and Grow Rich. Thanks for listening,